We're going to look at the direct write-off method on page 372. Page 372 is the direct write-off method. It says, recognizing uncollectible accounts expense using the direct write-off method. I'm going to read the first 3 paragraphs and go through an example. We're on page 372. If uncollectible accounts are not material, meaning a very small portion of accounts, generally accepted accounting principles, that's GAAP, allows companies to account for them using the direct write-off method, meaning if you sell $14,000 worth of goods and services and only $25 or $50 is not going to pay you, you don't need to worry about determining what type of allowance for bad debt you need to create because it's such a small immaterial amount. Under the direct write-off method, a company simply recognizes collectible accounts in the period in which it identifies and writes off uncollectible accounts. No estimates, allowance account, or adjusting entries are needed. In other words, after a year or so of selling everything on credit, and if someone doesn't pay you the $25 or $50 out of the $14,000, then you go ahead and do a direct write-off. The direct write-off method fails to match revenues with expenses. And again, because you write off when you write off an accounts receivable, it's an expense, and you usually write it off a year later. So you're not getting the timing recognition is going to be off. Revenues are recognized in one period, and any related uncollectible accounts expense is recognized in a later period. Again, the timing the matching principle, when you match revenues to expenses, is going to be off. Also, the direct write-off method overstates assets because receivables are reported at face value rather than net realizable value. So what's going to happen is the $14,000 is going to be booked and considered the real value of the accounts receivable when in fact it's going to be slightly lower. And again, the reason why generally accepted accounting principles allows this is because the amount that's going to be written off for bad debt is immaterial. It's such a small amount, it's not going to skew, meaning throw off the overall value of the accounts receivable. If the amount of uncollectible accounts is immaterial, however, companies accept the minor reporting inaccuracies as a reasonable trade-off for recording convenience. So we're going to look at the example. Accounts receivable is $14,000. So revenue is going to be $14,000. We're on page 372. And AR is going to be $14,000. Revenue, $14,000. And AR is $14,000 as well. Now, you book this and you know that a small portion of this is going to be written off as bad debt. So as you can see below, on page 372, the horizontal financial model shows accounts receivable, $14,000, retained earnings going up $14,000, revenues $14,000, no expenses, net income $14,000. Now, if you go over to page 373, what happens is we're going to fix this. We realized that in 2014 that $70 is bad debt. So uncollectible accounts expense and AR. So what happens is we have to figure out how we're going to enter this $70 for bad debt. $70 is bad debt. And how do we account for this? So what we do is we increase $70, debit, credit, $70, and we're bringing accounts receivable down. So what we're doing is we're increasing the accounts receivable expense and decreasing our, we're increasing our uncollectible accounts expense and decreasing our accounts receivable. And that's how we account for the direct write-off method. And I believe this covers everything that was sent to me via the survey. If for some reason, it's early Saturday evening, if there's still something you want to go over, I've encouraged people repeatedly to give me a call. or email me, and I'll be delighted to do an individual review session with you via email or over the telephone, whatever works best for you, to make sure you're fully comfortable before you take in the exam. Best of luck with this. I hope these videos have helped, and keep studying. Again, reach out to me if you're having any problems. Thank you.